Hello, Charity. This is Isaac. I know I promised to have a discussion with you on the analysis of the stock market, but I know we haven't found time yet to be able to do so. So I decided to do something rather a bit unconventional by recording this video, and this just purposely for you. I hope that will be a very good resource that you can always refer to if there is anything that you fail to properly understand in this tutorial. Then by all means, I believe we can make time to go through it further. I believe by going through the whole presentation, you'll be able to come up with those areas that you need more clarification, and we'll see how best we can go about that. In this tutorial, I hope to cover just three main areas with you, and of course it's going to be just an introductory discussion, and I believe it will be a very useful thing. We'll begin by considering just how to analyze the financial page, or if we see the financial news, how to pick up those numbers and make meaning of them. I'll personally show you two main sites or websites that I normally use. They are Thomson Reuters and Yahoo Finance. We'll be concentrating a lot of our discussion today on Yahoo Finance, and with that we'll talk about the percentage changes and the changes in the various prices of equity, and we'll discuss the close, the volume, the open, and those values. We'll also look at a few of the derivatives, maybe the options, the futures contract if we find time, but that may not be all that important in this particular tutorial. But the next one that I would like us to delve a bit deeper into will be the analysis of data, and we'll use Yahoo Finance mainly for that. We'll try and download data and analyze the various indices like the mean or the expected return. We'll compute the standard deviation, the variance, and also try to convert them from their daily to the annualized values. And if we have time and if we feel a bit more adventurous, we'll see if we can prove the normality assumption with stock returns. We'll see how that goes. And I would like to intersperse this tutorial with a whole lot more of the tools that I normally use, and that is, while in Excel I'll be using a lot of the commands or the formulae that I normally use, and if any of them is new to you or are new to you, then hopefully they will all become of use to you in the future. So without further ado, I'll begin by considering the first page. I've already opened Thomson Reuters, and let's just go into Reuters.com. If you get here to get information regarding the stock price or the indexes, let's just go to markets. If you scroll down, you can see the indices. They are for the indexes. We have the stocks there as well. If we click on stocks, well, we begin with a search box that asks us to type in our code. The code may be Google, for example. If you type in, it sometimes pops up. If it's Finance Yahoo, this one, well, Google. If you click on the search as we did, we have GOOG, which is Google's stock ticker symbol as used on the stock exchange. If you click on goog.oq, now we have information regarding Google stock price, the volume traded, the average volume, and all that. Let's take them one after the other and see what is really going on here. Now, today is the 12th of May, but we're having 10th of May 2013, quoting Google's latest price as $880.23 US. Now, it's 10th May because today is a Sunday and it's not a trading day. So the trading day actually ended on Friday, the 10th of May. We have the price change 8.75. Now this can be a little bit tricky in really making meaning of all these price change, the actual price change and the percentage changes in the brackets as we find here. I would like us to go through, if you have your calculator with you, it may be useful for us to try and work this through together. Now, when you're calculating the price change, it is very important, or the percentage change, it is very important you know that mostly the information presented in the financial pages will not consider the open and the close. They will rather be considering the previous close and the current stock price. I'll say that again. Maybe I didn't state that quite well. Mostly, when the percentage changes are computed, they will not be using the open stock price and the current stock price. They will most likely be using the previous close stock price and the current stock price. Now I'm going to do the calculation here. I hope you're doing that there as well. So we take 880.23. We subtract the previous close of 871.48. That gives us 8.75, and that's exactly the figure we get here. Now to take the percentage change, we only have to divide this 8.75 by the previous close. So that's 8.75 divided by 871.48. If we divide that and multiply by 100, we get 1%. And so that is exactly what is happening here. So always remember, to make sense of this first page here, it is always the previous close of the stock price and compare it with the current stock price, and then basically take the percentage change between the previous close and the current stock price. The actual monetary change will be the 8.75, which is just the difference, and the percentage change is the difference divided by the initial close or the previous close value here. Now we have the volume that is traded and the average volume also given down here. Now today's low gives the lowest value that is recorded for that particular stock, which is Google in this case. Today's low, assuming today is of course Friday, which is in the past, 872.34 would be the lowest the value would have recorded on the 10th of May, and the highest within that very day will be 880.39. So it is obvious that at the close of the day on the 10th of May, the stock price fell a little short of the day's high on the 10th of May. Now the figures here are very similar to what we've discussed with the daily values. Here we have the 52-week high and the 52-week low. They are very similar. So over the course of the whole 251 trading days within a year, or the 52 weeks within the trading year, we have the lowest that the Google stock has recorded is 556.55, and the highest it's recorded within the whole period is 880.39. Now obviously, by the information we're looking at here, something strikes us. You see, these two are in green. Well, that is striking us. That's telling us something. Look at the day's high. The day's high on the 10th of May happens to be exactly the 52-week high. So the 52-week high for Google stock may actually be said to be the highest. The day's high recorded on the 10th of May happens to be the 52-week high for the whole 52-week period within the stock trading period. Alright, so that's basically the little bit of information that I would like to show you here if you happen to be on Reuters. Well, there are other information, of course, that you can glean whenever you come to this page. That could be the assets beta. The beta is basically the stock's responsive responsiveness to the changes in the whole market. And the market, normally we proxy the market by using the market indices like the S&P 500. We've got the FTSE 100 if we're thinking of England or United Kingdom, for example. These are market indices, so we can compare the responsiveness of Google stock to such benchmarks and see how they respond to it. A beta of 0.94 or a beta of less than 1 means that the stock is a little less responsive to changes in the overall market conditions, such that if FTSE 100, for example, happen to move, assuming that our benchmark is FTSE 100, if FTSE 100 moved by, say, 20%, then a beta of less than 1 will mean that there is going to be a corresponding change in Google stock price by less than 20%. And similarly, but 0.94 is very close to 1, which tells you that this stock beta moves almost in unison with the benchmark or the overall market condition. Now you can find news about Google stock price, all the information you may need down here. We're not going to go into all of that, but other things you may want to look at will be the financials. Under the financials, you'll be able to get information regarding the company's statements, important revenue, sales items, its earnings per share, its valuation ratios such as the PE ratio and all that. You can get that information here. And not only that, you get the information for the company itself, and it gives you the industry average as well and the sector. So you'll be able to tell how Google in particular is performing in relation or relative to its competitors. We have options as well, and of course with the options we're going to have information regarding the call and the put options, and it necessarily is definitely going to give us the direction in which the market is viewing the future market movement or the price movement of the Google stock. We'll look at this one in a bit more detail a bit later on. And of course, you can also have a look at what the analysts think of Google. So you get information regarding all, as you see here, we have the historical surprises and consensus estimates trend. You have all the analyst estimates and the revisions and all that. Well, that is one website that will come in handy in case you would want to use any of these features. But I'm more likely going to be using Yahoo Finance a lot more, and the reason I do so is because the download of data from Yahoo Finance is a lot more easier, and you'll be able to download it into your spreadsheet straight away without too much editing. So without further ado, let's just go to Yahoo Finance, and that is type in finance.yahoo.com. And you have a similar information here. On the first page, you're going to have all these. Of course, where we typed in our ticker symbol or the company that we were looking for, it's exactly the same here. We type in, be it Google, Apple, whatever, we can type in and get all the information. Here on the top of the screen, you have the Dow Jones Industrial Average, you have the Nasdaq, and here is the currencies. It's telling you the euro and the US dollar exchange rate. You have the bonds, the 10-year bond yield, and if you click on, you will be able to get into other terms as well. We have the commodities to the right hand side. Without further ado, let's try and look at how we can actually download data from Yahoo Finance into our Excel page. And whilst there, I'll show you all the neat tricks and tips that we'll need in order to be able to make sense of where the stock is going. Just so we don't get bored, I'm not going to use Google once again. Let's pick a different stock price, and I would like to pick the competitor, Apple. When you start typing, normally it will come up, the stock ticker will come up. If you look down here, it tells you Apple Inc. That's equity, and that's equity we're looking for. It's traded on NASDAQ. So we have to just be precise as to which one we're looking for. Now, when you do that, we have a similar page that opens as we saw on Reuters. Now we have all the previous close, the open, bid, ask, and just to test you, you may want to go through this and see if you will be able to compute these values here yourself. And just a reminder, if you want to get these values here, calculate them yourself. What you do, as I mentioned previously, is you don't take the open and the current stock price. You're going to take the change between the previous close, which is 456.77, and today is 452.97, to check if these values are right. I'll check that quickly just to make sure that I'm telling you the right thing. So the previous close is 456.77, and the current stock price is 452.97. I'll just take the percentage change on my financial calculator, and of course it gives me 0.83%. And in terms of monetary change, it's just the difference between 456.77 and this one. And of course, as the stock price has dropped, it's obviously going to be a negative change, and so it's in red because it's fallen. If it had gone up, it would be in green. The rest are things that you can probably work out yourself. What I'm going to do now is probably the most important that you will ever come across. Well, for me, in terms of the lectures we've had so far, I think the most important that we've always had to deal with is this particular tab here. It says the historical prices. Historical prices. When you click on the historical prices, you'll be able to zoom in into the historical trends of whichever stock you've picked. In this case, we've picked the Apple stock. We'll be able to type in which date range we're interested in, and once we are satisfied with that, we'll download the whole data into Excel for more analysis. For simplicity, well, let me quickly show you what's here on the right hand side. Of course, after choosing the dates, we can decide whether we want daily ranges, weekly ranges, monthly, or dividends only. I'm going to base my calculation on daily ranges. Of course, you can happily try later on with the weekly and the monthly ranges. Let's pick a range. I'm going to consider like a year's return, or maybe 2 years return. What's today's date? Today is 12th, but unfortunately it's a Sunday. Let me begin with 10th as 10th, or even the 1st of May. So let's go to May. Of course, I could have started. It's not May, sorry. 1st, and let's go to May. Let's start from say 2011, and of course we'll end at May 1st. I don't even know if that is a weekend or not, or whatever. It doesn't matter. So the 1st of May 2011 to sorry, the 1st of May 2013, and I'm going to choose daily. You can choose weekly, monthly, dividends only, or whatever. One other important thing I would like to mention to you, Charity, is the fact that if you look here, we have exactly the things we've talked about. The days open, we have the high and the low, and then the closing price. If you're interested in just the closing price without any adjustments for like any stock splits or dividends that were paid out and all that, then you just concentrate on the close. But if you were interested in the total return that can be achieved by an investor, you use the adjusted close. Just for your information, in most of our lectures we've been advised by the lecturer to use the adjusted close, just for the reason I've already explained, and that is to make sure that you are making adjustments for the total return that the investor gets, and not simply the change in the assets price. Remember that when somebody invests in the equity market, when somebody invests in a stock, the person is not only entitled to capital appreciation, they are also entitled to dividends that are paid by the firm. in which they are investing. So by considering the adjusted close, we'll be able to make adjustment for all the extra dividend payments, all the stock splits, or whatever that might have affected the actual value to the investor, so that we get the best reflection of the value to the investor. So for now, I'm going to just stick to that particular rule. It's not a rule, but I think it just makes sense. We're going to use the adjusted close for most of our computation, but first of all, we have to get this data into our Excel spreadsheet. Yeah, and I bet you've seen that already. To do that, just scroll all the way down. You see download to spreadsheet here. Just click on it. And here I'll advise that you don't open the file. It says open the file, won't be saved automatically. I don't know if it actually happens on other people's machines, but I've tried almost 100% of the time and haven't actually been able to open it directly like that. But I think it's even easier that you use the last option here, and of course it's worked 100% of the time for me. Click on Save As. You can give this a new name. I'll save it as apple.char, because there's apple for charity. Well, I'll click on desktop and try and put apple.char there, and let's see if I can find that, because my desktop is full of stuff. Yeah, here we go. We've got apple.char. Just double click apple.char, and here we are. And of course, I believe you're not new to Excel, so you already know we have to double click this to open up the data, having the hashes, because there isn't enough room to display all the information. What we do, as you already know, is to highlight just the middle between A and B, double click, and there we go. So we have all the information nicely presented here. Now if I wanted to just scroll all the way down and see how many observations I have, that will take ages. Charity, don't do that. So I'm going to show you some neat tricks that you can use to navigate the whole environment while you're in here. Simple commands. If you hold down Control and the down arrow, you'll be at the very last page. The same way, if you hold Control and the up arrow, you'll be at the very first page, the very first value in the series you're considering. Okay, that was just by the way. Just like I mentioned, I'm going to be using a few tricks and tips that I use when I'm in here, and I hope to share that happily with you. Alright, first of all, we have to bear in mind that you see the range 10th of May 2013 happens to be the most current figure, which means I'm going to use the command again, Control down arrow. We can see the 7th of September, is it? 1984. Was that what I did? We've downloaded too much data. I actually wanted up to 2011. Maybe I made a mistake there. Charity, you should have corrected me. Alright, so what I'm going to do is I'm going to cut it off at 10th of May 2011. Where are we? We're in 2012, sorry. So let's go to 2011, and that's June. So 10th of May 2011. Okay. We have 5th of May, 6th, 9th of May. Alright. So 10th of May exactly, that's up there. Now I can select the whole of this like that. Or you could just, I'll show you another trick. Just click here. What we're trying to do now is just to delete all the observations below that. I just don't need to consider too many observations like that. If you click just on one cell like that, you can use the same command, Control, but this time hold down the Shift arrow and then the right arrow key just to select across. Hold down the Control and Shift together again, and then this time the down arrow, and you select everything. And of course, you can just hit the delete button to delete all the observations. Whilst here, I'm not going to scroll all the way back up again, so you can just the Control up arrow to be on the very first observation. Here we are. I'm ready to go. We have 10th of May 2013 to the 10th of May 2011, of course, because the data in the reverse order. What do we do here now? As we've seen that the data are in reverse order, what we are interested in this particular page is just the adjusted close, as I've mentioned to you. We're going to chart the trend of the stock price and see the movement, the rate of return, the average rate of return. If you had invested in this particular stock over this 3-year period, what would have been the average your portfolio, which includes only one stock at this particular moment, which is just the Apple stock? What return on the average would you have earned in every particular year? And I'm going to show you 2 different approaches for doing that. Before, just to minimize the amount of information we have on the screen, I'm going to try to delete all the informations in between. You can just select by clicking on top of this B over here and then dragging across, just select all these other columns. What we're going to do is we're trying to delete all these observations in between because we don't really need them, Charity. What we'll do is hold down control, and then hit the minus key, and that deletes all the observations in between. Now I'm trying to insert another row above this, so if you hold down control and shift together and hit the plus key, that will insert another row above it. Okay, now what I'm going to type to this side is basically the return. The return is going to be, of course, the return, as you know, the percentage change in the stock price. And we'll use 2 different approaches to computing them. First, we'll use the normal returns calculation, and then we'll compute the returns based on the logarithms, the natural logarithms. Let me just put ln in the bracket so we know what we are doing here. And when we look at the number of observations we have, it's a lot. Do we know how many observations we have? I like digressing a lot. Let's see how many observations we have. And I'm not going to scroll down like I told you before and count everything I have here. I'm going to use another simple trick to show you how to count all the observations in case you needed to. Counting 1,000,000 observations, you can't do that. Don't do that. Alright, let's use the formula. You can always type in equal to count. If you double click on this FX button, alright, now select the first value. Again, Control Shift down arrow to select everything. Hit the enter key. Let's see how many we have. We have 504 observations. So we didn't have to count them, but already we know we have 504 observations. So we're not going to compute for every single value the returns. We're not going to compute 504 returns. Alright, what do we do? Let's use the formula. Let's use the formula. Well, the formula is simple. First, let's think of the changes, but be mindful the date is in reverse order. So we have in the most current price here, and the price before is the old price. So what we can do is, if we start here with equal to, we're going to have our current price, okay, minus the old price. If we put brackets around these, okay, divided by the old price, which is this one, I hit enter, we have the return. Now the return may be stated as normal return as a decimal, of course, without converting into percentage. I mean, or we could convert them into percentages just to give us a sense of what the percentages actually are. If we wanted to do that, we'll just multiply by 100 to get the return in percentages. Actually, if you have time, I can just do that. I selected the whole of this column. I'm going to introduce yet another column. We'll do that by clicking Control Shift plus to introduce another column. This time I'll type in return as a percentage. Okay, so what we're going to do now is type in the formula equal to, select this cell, multiply by 100, and that's it. So the value here is a percentage. It tells you that from 9th of May to the 10th of May, the share price of Google fell by 0.83%. Well, of course, you could just look at the whole decimal, not the percentage, as 0.0083, which is a bit harder to read, but you get the picture. Now we're trying to do the calculation for everything down here for the whole of the 500 and something observations we did. So let's do that. We can select the first observation here, control down arrow to go all the way to the bottom. Go this way because this is the column that we hope to fill. Control shift up arrow to select everything. And so to copy the formula down, hit Control D. How cool was that? Did you know that? Control D will copy the whole formula all the way through, so you don't have to do it all the time like that. You can use the same thing over here as well. Click on anywhere in this particular column, control down arrow, just a shift to the right hand side, control shift up arrow to select everything including that first value there, control D to copy the formula. So we have these in percentages. Now if you saw something there has div hash whatever. Let's go down, control down arrow. Now we have these here because a return is always computed as the difference between an old price and a new price. And as far as our table is concerned, we began from 10th of May. But to compute the return on the 10th of May, we need to have the information on the 9th of May, which we don't have. So for simplicity, just ignore this very last observation because that is what it will be. We can just ignore the whole of this and use the rest of the values to compute whatever we need to compute. That makes things easier. That's just logical that will happen. So that is showing you the normal way to calculate returns. The normal way to calculate returns. Now we can always calculate returns using the natural logs, natural logarithms. Now why do we do that? In investment practice, in practical investment situation, you believe that the returns to a portfolio will be reinvested such that the whole portfolio earns a return based on the overall value of the portfolio. What basically I'm trying to mean is that people are not withdrawing from the portfolio on say daily basis, and so whatever is earned is reinvested, and so there is, if you like, a cumulative return that an investor will generate over a period of time. And it's the natural log that helps us to simulate that investment practice, because the natural log will consider a continuously compounded sort of rate of return that is available to the investor. Now how does that happen? Remember, if we look at the formula here, it was just the change in the price over the original price. Now similarly, if we're using natural logs, it's just simple. Just type in equal to natural log ln, double click on this function to bring you. Of course you can type in everything. Ln is always going to be the new price divided by the old price if you're using the natural logs, and the new price, of course, like the 10th of May is this 0.83. Of course you can use this one, whichever one you use, it doesn't really matter. They will work because it's just the same. Yeah, for simplicity, no, sorry, I'm lying to you. We're using the new price. Sorry, these are returns. I told you that is an alternative calculation, so we're still using the price just as we did for the normal returns calculation. So it's the new price divided by the old price. Okay, you can choose to close the bracket, or you can choose to just hit the enter button, and that will finish that for you. And of course we can fill it the same way as we did before, or if you like you can include the percentage. I tell you what, yeah, let's just do it. Returns as a percentage this time. Okay, so that will just be equal to 100 multiplied by this value over here. Just hit enter and that will do. So what we're going to do is to try and go all the way. Actually I can show you another quick trick. It doesn't always work, but hopefully it works this time. Instead of going here and then control down arrow and right and then control D and whatever, you can just highlight just this cell here, and then when you highlight, just mouse over this corner, you see the crosshairs, just double click it and it sort of fills it neatly all the way. Let's just double check that it's done the right thing. Control down arrow to see it. Here we go. So we're good. Control up arrow to get back where we are. I'm going to use that same neat little trick to fill these again. Again, mouse over the crosshairs and double click, and that's beautifully done. Again, what I'm going to do is to try and separate these two forms of calculation by introducing yet another column. Control Shift plus to bridge, to create a gap in between them. Yeah, I like to add a bit of color effect in my presentation just to give it a bit more of an interesting. Sorry, must be this one. Okay, just a separation. Control up arrow. Here we go. We've done all we have to do now. Just I put this row here, inserted this row here, but I didn't really use it for anything. Okay, so instead maybe we can just type in something there. Just apple stock analysis. Okay, alright, now I'm gonna select the whole of this range, and then I'll just merge and center. Probably Control B to bolden it. Control Shift right arrow just to increase the font a little bit like that, and it looks good. Okay, now I told you we're going to look at a few of the indices, basically the mean, standard deviation, variance, and the conversion to the annualized values, because we're looking at the daily values here. Let's begin with the expected return. So the expected return, of course this will be the daily expected return. It's just basically the mean return. That's what we'll calculate first, and then we'll look at the standard deviation. Standard deviation, of course, that's going to be daily standard deviation as well, and then we'll look at the variance. Okay, that will be daily as well, and last but not least, we'll look at the conversion. So we'll look at various conversion to annualized values. Okay, annualized values. So once again, let me just copy and paste these ones. Control C. Okay, Control V down here. So these ones are simply going to be the annualized values and not the daily ones. Just 1 second. Okay. Right. Expected return daily, that's simply the mean. The mean is simply the average. We're going to average everything here, and as you probably know already, the average is simply equal to, you have to type in the formula there, equal to, when you start typing average, the average comes up. If you double click on the function, we'll be able to select, sorry, I clicked on the wrong thing. Okay, average. Alright, now the average of what are we looking for? We're looking for the average of the returns, the average return. Because we have the daily returns, we want to average them and see what we get in a particular day. The return we get is an average for a day over the whole period, and the consideration. The period is from 2011 to 2013. Okay, now of course we could use this one or we could use that one. The difference will be very, very slight, very small. Of course you can tell the differences here are not that huge already, but of course they are quite close. So let's pick the normal returns. For example, let's use the percentages so that our values are already in percentages instead of reconverting them into percentages. We just use the percentage values. All right, click on the first one and Control Shift down arrow to select everything. But mindful of our last value, of course, diff 0 will give us an error if we try to do so. Well, I haven't tried. You may try, maybe, but we're not going to include that observation because it adds nothing whatsoever. And of course, just losing one observation out of 504 observations isn't too bad. When you finish doing that, just hit enter and we have our value. The return is 0. So the return is 0.074191 as a daily return. So on the average, a holder of the Apple stock is going to realize, or the holder of the Apple stock will realize on the average 0.07%. Remember, that's a percent. We didn't pick from here. We picked from here. It's just a 0.07% appreciation in the value of the stock price. Or over the 2-year period we considered, the average daily percentage increase in the stock price of Apple was 0.07%. Remember, that's just daily. That's not the annualized figure. Alright, let's do the same for the standard deviation. We can use equal to, when you start typing stdev, we have stdev-p and stdev-s. Of course, depending on which Excel version you're using, you may have slightly different sort of descriptions here. I'm going to use the stdev-p, assuming I have the whole population. It's not the best assumption there is, so you can feel free and use the stdev-s, knowing that we're only picking a sample out of the total universe of stock returns that would be available. I'm going to go ahead and use the stdev-p just for the benefit of this discussion. And I'll use the same returns. Control Shift down arrow, hold Shift down and then go up by 1 just to deselect that div/0. Hit the enter key and we have our standard deviation of 1.91. And remember, the standard deviation of 1.91 is 1.91%. These values are in percentage point. I'm going to introduce one more row up here. Control Shift and plus to introduce one more. Okay, so I'll just give these daily values and call this percentage. Okay, percentage. Okay, right. So the variance is just the square of the standard deviation. So that's simple. Equal to, how do we do the square? The square is just equal to, click on this, and the square is Shift. Of course, on your keyboard it may be the number 6, just to get this symbol. I don't know its name. So is that value, and then you put 2 there. That shows that you're squaring the value. So hit enter, and that gives you the square of the standard deviation. So that is what we have here. Now comes the fun part. Of course, easy. It's the conversion from the daily values to the annualized values. You would normally hear that the S&P 500 or the Google stock price or the Apple stock price on the average yielded an annual return of, say, 21%, 4%, 5%, or fell by 16% whatsoever. How do we do that? Well, simple. Well, in a normal trading, the normal trading duration, trading days within a year, we have an average of 251 to 260 days. You'll find that on Yahoo Finance, it will probably be 251 days. Okay, so whichever value you get for our daily expected return, we're going to multiply it by the 251 trading days there are, in a year, and that will basically be the amount of average return that the investor would hope to get in every single year. So that is equal to the expected daily return, or the mean return, of 0.074. Click on that, hit the star key for multiplication, and then so times 251, hit enter, and so we have 18.621. all right, such a handsome return, 18.6% of a return on your investment. That's not bad at all. Let's go for the standard deviation. Now the standard deviation isn't going to be a straight multiplication of the daily standard deviation and 251. That would be wrong. I hope in some of the earlier discussions we've had in financial risk management, or in finance in general, you remember the rule that variance scales with time, whereas standard deviation scales with the square root of time. So what we're going to do, if you remember in value at risk calculation, you multiply the daily value at risk by the standard deviation of the new time range you're going to consider. So if the time within a year, if our conversion is to an annualized figure, which is a year, and we are assuming 251 trading days in a year, then we're going to multiply our standard deviation by the square root of 251. So standard deviation is equal to our standard deviation per day times, we have the square root. The square root, to do the square root is just a matter of multiplying 251, oh sorry, 251, yeah, we raise 251 to the power half. And of course you can use 1/2 or just 0.5. I prefer to use that to make things simple. So our daily standard deviation multiplied by the square root of 251 trading days in a year will give us the standard deviation for the whole year, which is 30.3%. You know what the variance is. The variance will always be the square of the standard deviation. So it's equal to this raised to the power 2. That's bad. So we have our standard deviation. Let's see, did we do something right? Let's see. Okay, standard deviation multiplied by the square root of 251 within the year. Okay. Escape. And then the variance is equal to the square of the standard deviation, which is quite odd. I hope I've done everything correctly. Well, that's how it's supposed to be. Okay. Now with all these information, then we would have computed the expected daily return, the standard deviation, the variance. We've computed the expected returns and the standard deviation, made the computation to the conversion to the annualized values as well. And last but not least, some people want to know how the returns plot as well. And of course, that will be very, very simple. If we wanted to know how the returns plot, first, using this set of values, we can just click on the first one, Control Shift down arrow to select everything, Shift up arrow by one step. So we have everything selected, excluding the div/0. We go to the Insert tab over there. We go to Line and select any one of these. Of course, we're going to have the favorite diagram that we love to see. I'm going to move this chart into a new chart and call it the returns. Yeah. The returns, yeah, as a percentage. Okay. Alright. So that is our returns as a percentage. Of course, you can customize that. Let's see what else we can do. With this, you're going to see how the price has fluctuated over the period. That is quite interesting. This is quite a trough. If you wanted to call out the value here and see what exactly happened there, you can add data label. You can use a data label or a data call out, for example, to give you exactly what figure there is over there. Okay, let's return to our chart. This time we're going to use the logarithmic returns. I'm going to do exactly the same thing. Control Shift down arrow, Shift up arrow by 1, insert and line. Okay, select one again. You can see it's basically exactly the same as we had over there. Okay, it's exactly the same as we had over there before. Alright, so let's move the chart and call that returns. Okay, logs. Okay, now let's return to our whole page again. What do we want to do? Sometimes you just don't want to see the returns. That fluctuation doesn't really tell you much. It only tells you about the variability, the volatility of the stock pattern. But some people want to see how the stock has trended from its initial price to its current price. And so we can use the actual stock adjusted close or the actual stock price, select everything, Control Shift down. So this time we don't have to shift by any steps upwards, because you can select everything. There is no div/0 down here. So we can insert again line graph. Okay, now we can move the whole chart into something we can call the price trend. Okay, Apple price trend, for example. So that's how Apple has trended over time. We could customize it the way we want it. Okay, maybe this one looks a bit nicer. So that is it. If we have time, Charity, I think we can go through a lot more things. I always have a lot more to give than I can give, because I end up talking too much and probably run out of time. I don't want to bore you too much with the information I have here, but I believe that you probably had a bit of information based on what we've done so far. Just a recap of what we've done. We've taken a look at the actual financial page and discussed all the information, not all the information, most of the basic information you would need in picking up an understanding of what they mean regarding the movements in the stock price, the percentage change, the open, the volume, the previous close, and the high and the low, and all those other bits of information. We had a quick look at where the options information were as well, so we'll be able to probably tell where the public or the investor's perception of the trend of the market would probably be. We've finally looked at the analysis of data by actually downloading data from Yahoo Finance and then plotting that in our Excel to make further analysis. Next time, if we find time, we will be able to talk about the normality assumption and try and see if stock prices or stock returns are indeed normally distributed. I hope we'll have fun doing that. So for the time being, I hope we've done more than we need to do really in a session, so you'll be able to have time to go and pore over it and try and pick up as much as you want, and of course practice as much as you want. So with